I'm excited to get ready for our main event with Mr. Feras Moussa and Ben Suttles. I've known Feras for a couple of years now. We collaborated on some projects and got to talking a lot about real estate investing. And then he was like, "Hey, I'm really looking into buying apartment complexes." And I mean, you never know. I was like, "Cool, awesome, man." And that was about it. And then we reconnected, 12 months later. And he was like, "Yeah, I bought like 400 units over this time period." I'm like, "Wait, what? What'd you do?" And he was like, yeah, I met this guy named Ben Suttles. And just, I don't know, they just started like just crushing it. So since then, they've acquired 1,600 units with over 2,500 units under management. Now, if that's not crushing it, I don't know what is. And tonight we've got them to talk about how to invest in multifamily. And they're going to show you a case study of an actual deal so you know what to look for and how to analyze a deal and all the craziness that goes in between finding a deal and then actually closing it and managing it. So without further ado, I'm going to bring up Feras and Ben.
Hey, how's it going, guys?
Hey. Thanks for having us, Chris. Appreciate it.
I need to play that.
That goes both ways, man. You guys have been rocking and rolling too. You're the most consistent guy I've ever met on the flipping side. And you think our business is hard? I think yours is probably harder. So very different. Yeah. It's kind of world, I'd say. So
tons of moving pieces, man. Yeah, you guys are crushing it. So we appreciate it. Hopefully we can add some value tonight.
All right. So you've got screen share ability and it's all on you.
As Chris mentioned, thanks for having us back on. So definitely excited to be a second time champ and hopefully in a few years we'll come back third time. We'll bring the heavyweight belt and call it a day. So I don't know what the record is in your kind of group for the number of repeats, but as Chris mentioned, right, we're going to go through kind of the ins and outs of investing in multifamily, right? It's really meant to be kind of a high-level overview, right? We're not going to do deep dives just yet, but really kind of to explain to people what multifamily investing is about, some of the things to look at, and kind of some of the different ways people can participate. But with that said, for those of you that don't know us, my name is Feras Moussa. I'm kind of, me and Ben are the two partners at Distrupt Equity. My background is actually software. So, I've always been in the software space, worked at Microsoft out of college. After that, I had a software company, and that's actually how I met Chris originally, kind of through that channel while I was also investing in real estate. And then, did that for several years and started investing in real estate passively in terms of just buying and kind of, long-term investments and learned about multifamily investing and syndications and fell in love with it, right? And started Disrupt Equity. I mean, it's the things that I personally like. It's numbers, people, systems, and processes. So that's kind of what I like to say about multifamily. And so, we've been kind of rocking and rolling, and I'll let Ben introduce himself and maybe a little kind of on Disrupt Equity.
Hey, well, thank you. So everybody, I'm the bald one on the bottom there, if you guys can't tell, but I also come from the IT background. I always kind of tell people, Feras is the smart one. I'm the guy that was in there kind of telling people how much stuff cost and what color you could kind of get it in. I was on the sales and business development side, but got into real estate in 2013. Like a lot of other people, started in single family. Where Chris is kind of crushing it right now. Just really wasn't for me. I was kind of looking for something that was a little bit more in line with kind of my sales and business development background. And so I stumbled across syndication and multifamily. And so I got into that in about 2015 and, was in another partnership prior to, starting Disrupt Equity with Feras. But we started that in 2017. And like our bio says, we bought over 1,650 units. And then we've got another couple thousand under property management too. So, it's been a fun ride. I did have hair before real estate for anybody that wants to know.
That's not true, Ben. You've never had hair. Come on, man.
I know. I lost my hair a long time ago, but I always like to say that joke. But so that's just a little bit about me, folks. All right. So a little bit of an overview. Did you want me to go through this one? I forgot.
Yeah, you get this one, disclaimer, Ben.
Yeah. So I get the disclaimer. I get the fun stuff. So we're trying to help investors achieve strong passive income with quality investment opportunities, right? That's kind of our mantra. So, we do that through multifamily syndication, right? We're a vertically integrated company. As you can see, there's a couple of our brands there down below. Disrupt Management is our property management company. Strategic Insurance Group is our commercial insurance company. Peak Financing is our mortgage brokering company. So we can help people find debt in commercial real estate, not just multifamily. And then we also have an education arm, right, where we're trying to kind of give back. There's a lot of misinformation and a lot of I'd say misguided information out in our space. And so we're trying to kind of, shoot it straight, give people the right information, the right tools so they can go out and be successful in any type of investment, right? It's not just multifamily, and that's investoracademy.net. So you can check us out there. That's just a little bit of an overview about Distrupt Equity. So the disclaimer, the fun stuff, right? This is, we're just coming in here, putting on a presentation, all the financial projections, all the information, or to the best of our knowledge is good information, but we want you to always talk with your CPA, talk with your lawyer, talk with your financial advisor, before you make any kind of an investment, right? So we're kind of putting this out for educational purposes, and I always get stuck with this disclaimer, man.
So if you guys have hard questions, go ask Ben or go ask a professional. So I recommend probably going with a professional, but I ask Ben stuff too, so it's all good.
Yeah, sometimes I'll get a right answer, but
I guess with that said, right? So kind of a high level overview in the agenda. All right, so we're just going to go through, basically why multifamily real estate, right? Some of the things that we like about it, kind of how we look at it, right? Ways people can get started in real estate and multifamily investing specifically. Right, different types of deal structures, what those mean, how people get started, and analyzing investment opportunities, really high level, right? What does an opportunity look like? What can you vet? What can you do? What the process looks like for both if you're passive or active. And we're going to go through a real case study. So a real deal that we did, and this was the deal that I probably told Chris about whenever we kind of first got rolling. So, and then we'll do Q&A at the end. So with that said, why we love multifamily, right? This diagram, I think, shows it nicely, right? You get cash flow, and we do monthly distributions, right? For us, our investors invest for cash flow. Additionally, our investors invest, we have cost segregation and 1031 exchanges, right? That leads to basically most of our business plans are about, natural and forced appreciation. The problem I had with single families is that there's nothing I can do to really improve that valuation of that property. The property valuation is tied to the neighborhood, right? With multifamily, we can do things that are going to force the valuation to increase, right? Because it's all based on income. That's how you value multifamily. Addition to that, right, we have investors, literally I have an investor texting me last week that is wanting to invest just for depreciation, right? Real estate tax write-offs are very powerful. Whenever Trump said he didn't pay taxes, for many years, it's because of real estate, right? It's a very powerful vehicle. And, again, sophisticated investors understand that we pass through a lot of losses to our investors. And it's something that's really unique, I think, on the multifamily side, because in single family, you don't get the bang that you do in multifamily. With multifamily, we do what's called a cost segregation study plus bonus depreciation. And to give people perspective, I had a friend that called me after investing in a deal. We gave him his K1 during tax season, and he basically said he turned into a white-collar criminal because he had invested $75,000. We gave him a $60,000 loss year one, right? It's very powerful. So, Chris, for all of those, flips that you did or make the pops right, it would have been nice to have those offsets. And that's kind of a really powerful thing. And I think a lot of people really gloss over that. Next one's really, it's a low interest rate environment. Right now we're looking at new deals that our interest rate can be 3% or less, right? In some of these cases, kind of in that 2.9 to 3.3%. That's extremely low, right? And over time, these notes get paid down. So that really leads to leverage, right? You are leveraging your money. We are putting down 20, 30% down on these deals. The rest is being financed at these super low interest rates, right? And over time, those notes get paid down, you're cash flowing. It's a very powerful combination of things, right? And last but not least, scalability. That was the one that really I hated on the single family side. It's hard to scale that business, right? It's it goes to an operation intense play. Whereas in our assets, right, we have dedicated full-time staff that sometimes live at the property. Realistically, they are, they have an apartment there, right? But they are full-time dedicated and helping work through everything. And you're more putting the systems in place and enabling them. And so ways people can invest, and I think we get this question all the time, how can I get into multifamily, right? And I think everyone thinks multifamily properties are owned by, like Chris said, right? Warren Buffett owns, all the real estate, right? You think it's got to be this big company. Well, really a lot of real estate is owned by people like us, right? It's what we do, the most common way is called syndication, right? What a syndication is, long story short, if I had $50,000, I can go buy a $200,000 house, right? But if me and 20 of my friends had $50,000, we now have, $1 million that we can go put down to go buy a $4 million house, right? And so now we're able to do something bigger, better together. That's what a syndication is, and it's really not that complex, but it's a way to kind of really compound and not do just a house, but do a full-blown operation. So, with that said, the ways people can get involved. First thing is investing passively in someone's deal, right? That's the easiest way. That's how I first got started. You learn a lot by investing in someone's deal. You realize, how did they position it? Did they perform and hit their returns? Were you comfortable with the way you had to wire the money, right? Are they doing distributions? Are they doing monthly distributions? Are they doing monthly updates? You learn a lot about what it takes by doing that, right? I think it's kind of an eye-opener. And for us, our goal is to be the best operator we can. So I invested in several people at the very beginning just to see how everyone else is doing it and what can we do differently. Next one is buying a deal with your own money, right? I think a lot of people look at doing a 30, 40, maybe a 50 unit property because that's about, that's kind of on the upper end of what people can usually buy themselves. But the problem with that is that it doesn't scale, right? Your 50 units is a really awkward size because do you have full-time staff or not? And if you do, it's eating up most of your margin because honestly, one full-time employee in the office and one full-time in the maintenance side should be able to handle a 100 unit property. So if you have that same staff for 50 units, you're kind of killing your margins, right? But, buying a deal with the one is very popular. If you're able to do something bigger, great. That's, more power to you. Next up is really partner with someone doing a deal. I think this one's a really powerful one, which is basically go find other people to figure out how to add value to them, right? We have brought people into our deals that have added value in different capacities. The value could be finding a deal. It could be helping operate the deal, being boots on the ground and doing, construction management, sourcing equity. I mean, there's a lot of ways for people to get involved to be a true partner in a deal. Next up, syndicate your own deal, right? That's what we do, right? We syndicate, we put together the whole team, all the effort, all the pieces that are needed. And last but not least, I know these aren't really mentioned here because it comes up often, right? REITs, people think investing in a REIT is really investing in real estate. Not quite. It's really investing in a company that invests in real estate. You're not getting a lot of the things that we had on that for other slide before this one, right? You're not getting the depreciation. You're not getting a lot of these other really powerful things. And so, with REITs, they're tied to the stock market going up and down. My cash flow on properties is really not tied to the stock market, right? It's tied to other factors. And so that's kind of the ways to get involved. And, with that as well, right? The different deal structures. These are the three most common ways. These are not the only ways that deals are structured. And for anyone investing in a deal, I highly recommend reading your company agreement because not only are there nuances, there's different ways to structure it. And that, the company agreement is the legal SEC defined document that outlines, along with the PPM, what an investor can expect. And so, but these are the three most common ones. Right? First one's a straight split, where basically you're, a sponsor, right? So in this model, in our world, we are the ones sourcing the deals, closing the deals, and operating them. We are considered the sponsors. Passive investors are considered the passive investors, right? And so a straight split basically says that as a sponsor, we agree to share all of the profits, and I said profits because I'm not talking about the initial capital that gets returned to investor, but basically 20% of the profits come to sponsors, 80% goes to investors, right? That's an example of a straight split. The next up really, and this is a common one, and honestly, as a passive investor, this is my favorite. And even as a sponsor, I like this model because I think it aligns interests a lot, right? What's called a preferred return. All a preferred return says is that before the sponsors are allowed to share in that profit, right, a certain amount has to be given to the investors, right? And it's like, it's, for example, an 8% pref. That's the term we use. Pref means preferred return. 8% pref means that we have to ensure our investors have gotten an 8% annualized return on their investment before we can start to split that upside. And so a deal might be an 8 pref with a 70-30 split. What does that mean? That means 8% annualized to investors, right? Making sure that they get that whole. Then before any money left over can be split, we have given that 8%, and then the 30% goes to sponsors, 70% goes to the passive investors. And it's kind of really, it's aligning interest because it's showing that these sponsors aren't allowed to take money until they've performed for their investors, right? Next up is waterfall structure. It's similar to the pref model, right? And the waterfall, all it means is imagine a waterfall, right? It trickles and it might go flat. It trickles, might go flat. Don't think of Niagara Falls. Think of more like stairs with water on them, right? So, but it's really explaining that there are different levels. And once a certain performance metric has been hit, you can go to the next level. So, for example, it might be a 70-30 split until an 18% IRR is hit. IRR is a type of return. We don't have time to explain on this one. But basically 18%, up until 18% is hit at 70-30 split. But then after 18%, it might be 50-50. What does that do? That gives the sponsor a lot more of the upside if they home run the deal, right? And the deal we're going to show today, I wish we had done a waterfall, right? Because we home run that deal. Our investors did really well, and us as sponsors, we could have made more had we done a waterfall, but that's okay, right? And so the way people get started, right? First and foremost, get educated. Like Ben mentioned earlier, right? Doing webinars like this, listening to people. We have investoracademy.net that we've put together. People get educated. Go to conferences, events. I mean, you name it. Go get educated first. There's it's not a hard business, but there's a lot of nuances to kind of be aware of, right? Next up, figure out the role you want to play, what that looks like, right? Do you want to do your own deal? Do you want to partner with somebody? Do you want to syndicate? I mean, there's a lot of ways to do it. Next up, define the criteria, right? I am only going to do C, B value add opportunities in Atlanta. I'm only going to do A-class assets in primary markets in primary locations, right? And, understanding each of those have a different risk-adjusted return. Next up, build your network. This business is all about relationships. All the people same on single family side, right? I mean, I wish I was a better networker whenever I was back in the software world, right? It wasn't really part of the norm. Whereas real estate, I mean, network with everybody come one, come all, right? It makes it fun, part of the business. So that's probably even more important in multifamily specifically, right? That leads to opportunities, partners. That's how I met Ben. And last but not least, take a step and invest. So Ben, you want to go ahead and kind of kick people off on just really as a passive investor, what are the things people can kind of think through?
All right. So I think it's important, folks, that you have to vet the person that's bringing you the deal, right? I think that's, even if you're, kind of being a passive investor on the single family side, right? You got to vet the flipper, the person that's bringing the deal. Do they have a track record, right? What has been their best deal and what's been their worst deal, right? These are not all home runs. As much as we like to think that they are, sometimes there are challenges, right? And you just say, how did you handle that bad deal? What did you have to do to try to right the ship? Who are they partnered with, right? Making sure that you understand that it's not just, one person, one face. There might be 3 or 4 people in the background. Who are they? What are their roles? Does their investment criteria match yours? Like Feras said, if you're only wanting to invest in Class A properties in, say, Houston, but you're looking at deals that are presented by people that are only doing Class C deals in Atlanta, that doesn't match, right? So you really need to make sure and define what your box is, and then go and find the sponsors and the people that are doing those types of deals. Where are you looking to invest? Once again, goes back to what's your box? Do you want to be in Houston? Do you want to be in Atlanta? Do you want to be in some other market? Do they have any foreclosures, missed mortgage payments, lawsuits pending? I think that those are all valid questions that you should ask of a sponsor. Right? Are they signing on the loan? We know of some sponsors that don't sign on the loan. Well, why don't they? It's because they've had some stuff in their past. And I'm not trying to fault anybody. Things happen, but they should be forthcoming about what's the story there. And lenders, you will even be understanding to an extent about certain things too, especially if it happened in 8, 9, 10, and 11. Seek feedback and referrals from other investors too. I think that's the most important thing in any real estate business, right? Is, who's people using, who are the right vendors, who are the right sponsors, who's doing good deals, right? But on the flip side of it, right, you got to vet the actual opportunity too. So you've got one side of it, you got to vet the sponsor and the person putting the deal together. And then you also got to vet the actual investment itself. Is the sponsor investing in the deal? Is there skin in the game? Not everybody does. We do. We co-sponsor, we co-invest alongside our investors on every single deal, but not everybody does. And once again, I'm not saying one way is better than the other, but some investors expect that, right? And you should ask that question of your sponsors. How's the deal structured, right? How Feras had kind of described the different structures, and is that in line with what you want to invest in? What's the expected hold time? If they're going to hold on to the deal for 10 years, realize one of the things that is probably a disadvantage of investing in a syndication or an LLC is that it's illiquid. So just assume that your money is going to be wrapped up for 10 years. So make sure that you understand the hold times that, if they're projecting that it could go out for 10 years, that you might have your money wrapped up that long. What kind of fees are they going to charge, right? There's certain fees along the way. Some are more customary than others. And once again, I'm not here to knock, how many fees people take or what types of fees they do take, but just knowing that and asking that question is important. What's the business plan, right? I think you really need to understand, how are you going to achieve the returns that people are projecting, right? And it might not be a clear path. There might be some risk. There was some time involved in getting to that stabilization point where they can start paying those returns. And you need to understand what the risks are to get to to that inflection point. What's the current returns on their current properties? I think that's a completely valid question to ask. And obviously COVID has changed. Some things have had to kind of slow down just because of the market. But obviously, you need to understand, do they have a track record and what kind of returns have they paid on some of their past deals or some of their current deals? Go ahead and flip to the next one there. Investment process for a passive investor. So during the closing, right? So and this is just our process. What would happen is if you're on our email database, right, you're going to get an email. We're going to give you a high-level executive summary of what the deal is. We're going to invite you to a webinar. That's where we're going to really kind of go through the investor deck. We're going to have Q&A. All that's going to happen then. And it's usually an hour, hour and a half, right? You're going to review the deal. Then the next day, we open up the equity raise, right? When we raise capital, because that's what a syndication is. We're pulling people's money together as the down payment for the investment. That is going to give you the opportunity to review the PPM, the operating agreements. If you need to review it with your financial advisor or your lawyer, we always suggest that you do. It is sometimes lengthy. I'd say on average it's probably about 70 to 100 pages. So read the whole thing. There's important things in there that you need to understand. There's risks involved in any investment, and that's where the PPM is. And then the company agreement is just as important, right? What happens at a sale? Who gets paid first? What kind of fees are being charged? And then if you say, hey, I like what they said in the webinar or in their investor deck, I've reviewed the PPM, I'm ready to invest, right? So you sign off on the documents, you send the documents in, and then you got to make that wire transfer. You got to take that step into the void, right? So during the hold, what to expect as a passive investor, really? You need to expect at least monthly or quarterly updates from your sponsorship group, kind of giving the executive summary, providing financials as to how the property is doing. And you need to review those, ask questions. It's in your right. That's your money that's wrapped up in the property, right? And see how things are going and compare it versus the projections, right? And if they're off track, why? And what's the plan to get back on track? And then distributions when they're available, right? Sometimes it takes a little while. We don't like to say that we flip some properties, but in reality, the one that we're about to do a case study on, we kind of did flip. So, distributions, might happen at the end, but when are those going to happen? And understanding the frequency of that is very, very important. And then knowing what your rights are during a sell or a refi. Are there voting rights to say, yes, I want to sell or I want to refinance, or is there not? When does the return of your capital or the money that you have invested in it, when does that happen? And then on top of that, when do the profits get returned? So knowing all that should, be first and foremost in understanding how the whole investment works. And a lot of that's going to be outlined in the PPM and the company agreement. And if it's not, you need to ask that question. But you can also leverage your 401k or your IRA. We always tell people that, right? I know I saw Quest, and we have a really good relationship with those folks. So people that do have those vehicles, you can invest into syndications. So buying your own deal. Say, I don't want to do the syndication thing. It sounds like a bunch of craziness, right? You can buy your own deal like Feras was talking about. People usually start at something a little bit smaller. It is a fair amount of money. You're going to tack on an extra zero or two. But I think it's certainly possible, and we know a lot of people that have done it. But you need to understand what area, what size, what condition, what type of returns are you looking for? Who's going to be on your team? As much as people, maybe you have, somebody that wants to do it solo, you still have to have a team. You need to have a lawyer. You need to have a CPA. You need to have a title company. You need to have potentially property management. Who are those people that are going to help you buy that deal and ultimately manage it successfully, even if you're doing it on your own, right? And then having deal flow. It's just like being an agent or looking for houses that you can flip. You have to look at a ton of deals in order to find one that works. There's a lot of deals out there, but not a lot of them are very good. So you need to have a fair amount of deal flow coming in so you can weed through some of the worse off deals and find that diamond in the rough. And ultimately, you need to realize, do you have the time to do this, right? I use the example, if you're an ER doctor and you're working 80 hours a week, right? Buying your own deal might not be the best route, right? Not to say that it's not possible. In fact, we know a lot of doctors that have done it, but they have a very, very good team. So just realize, that you might have, a little bit of scarcity in terms of time too. And so that's going to be one kind of setback to buying your own deal and how big of a deal you can buy on your own. So that's kind of buying your own deal. So the clock is ticking, right? Just as a closing on a single family home, you're getting shot out of a cannon just like you would be on that, just the same way.
I'm the one on the left.
Yeah, you are. I don't know how I got that hair, and I'm not a redhead, but whatever, it is what it is. So, a lot of things have to kind of come together if you want to buy your own deal, right? And as a syndicator, right, we're doing all of this. Our passive investors are really only supposed to be doing like 4 things. They review the paperwork, they sign the paperwork, they wire in their money, and then they sit back and wait for their mailbox money, right? And it's not even mailbox money anymore because we make ACHs. So the money just gets dumped into their bank account. But in this scenario, if you're going to buy your own deal, you have to understand how all this works and make sure that you get it done in time. So you got to line up the debt. You got to line up your financing. Who's your lender? What kind of terms are you going to get? If you need to bring additional JV partners in, or you have to have the equity, the down payment, you got to line that up. Legal, you need a lawyer to review the PSA and, maybe some additional docs, right? You need a good title company, you need a good insurance company, and you need a good property management company. Really, property management is one of the biggest players in being successful on these multifamily deals, right? This is not something that you're going to be replacing your own toilets and painting your own units, right? In a lot of ways, third-party property management, can make or break a deal, and you need to have the right team member on your team to make it successful. But this all has to happen usually within a 30 to 90 day period. Typical closing periods for us are 60 days. So, but it's all about leverage. We're leveraging debt. As Feras had mentioned earlier, right? We get some incredible debt on multifamily properties right now, 3% or less on fixed terms for 10, 12, sometimes 15 years, right? That's locked in, folks. That's not variable rate. You're leveraging equity. So that means you're leveraging other people's money to get into these bigger deals where you can tack on those extra zeros at the end on the purchase price. You're leveraging time, right? So, maybe you are that doctor, but you want to buy your own deal, right? You might leverage the time of your partners on the deal, or, the vendors on your team, right? That have the time to dedicate to the asset and make sure that it's going to be successful. Experience, people starting off, I don't know what to do. Well, if you have, say, money, but you don't have the experience, guess what? You can usually partner with somebody that does have experience and kind of learn alongside them. And that's probably the best way to learn, is getting into a deal, adding value, and learning along the way. Because, there is some education out there, but it's a lot of this hurrah stuff, how to underwrite a deal, how to raise money. But ultimately, where you make money is going to be, after you bought the deal. And that's all about the operations of the property, asset management, property management. So leverage somebody that has done this, folks, because it's very, very important. But also, before we kind of get into the case studies, leverage your contacts too, right? It's important to kind of know people that are, have industry contacts, know that person that can lend on a property like this, that has a good title company that can do multifamily. Because ultimately, if you don't have the right team, you're not going to be successful. So I'm going to go ahead and pass it off to my business partner. We're going to go through a little bit of a case study here.
All right. So we're going to talk through a deal called Woods of Decatur. It was our first deal that we did in Atlanta. And really, I'm going to kind of just show a few slides. I know we're short on time, so we're just going to kind of talk through a little bit like why we bought this deal, what we saw, right? And so this is actually the slide that we presented to our investors, right? We expected 10% cash on cash, 100% return in 5 years, and we put about $900,000 in improvements in it. But why did we buy this deal? First thing was location. Yes, it was kind of southeast Atlanta, not the best pocket, but you could clearly see that the kind of coming out of downtown, each exit was improving, right? Sorry, I guess each exit arguably was deteriorating, but as you go west to us, the areas are improving. And so you could tell that we were basically in the pathway of improvements, right? Which is definitely the first thing that we saw. Second thing is, we knew that the deal across not far away was purchased at $39 a door. They were putting a huge rehab into it. And that was a deal that ultimately sold for $120 a door. We were buying our asset for $38 a door. Next thing was management. We knew the guys currently managing had no idea what they were doing. They were accidental landlords, right? A complete disaster. And that was just obvious from day one. And third but not least, there was high demand. The deal across the street had a waiting list. This deal was like 80% occupied on paper. Ultimately, we brought it down to 40% and then brought it back up to 95%. Right, but we knew that had we gotten, and one thing I guess I didn't mention on here is that there's 9 down units, right? We knew if we can get those down units online, right, because of the demand, we can get them all leased up, right? And now we've increased the income of the property by that 9 down units, let alone just operating it more effectively, right? Improving the income results in improving the value. So, here's a quick slide on the deal. You can see, the deal was that red dot, but basically right across the street, the fully occupied 2 months, there was a nearby mall. There was a Walmart down the highway. Right across the street, a new development went up after we got under contract. Not far away, again, another new office development that went up. And again, there's that B class that was that vacant property that was turned into a B property. And really showcasing it, right? Here's kind of what we presented to our investors. We expected to do a refi after year 3. And after that point in time, right, we would get some money back out for investors and then basically hold on for another couple of years, right? And really modeling in kind of an 8% exit cap. We were expecting to basically, after 3 years, investors would have gotten about 42% of their money back, right? And overall, I mean, it's a deal that would double in 5 years. That's what we presented, and that's what we expected to do. Now, and again, these numbers are net, and then I think that's one thing we didn't really mention earlier. Make sure the numbers that you're being presented are net, to the investor's bottom line, not just on the project, right? And what I mean by that is that this includes the share with the sponsors, right? And really, here's what we ended up doing, right? So after the fact, so we did probably a bigger eviction up front than we expected in terms of just cleaning out all of the bad elements of the property. Again, it was being very poorly managed, drug dealers, you name it, it had it, right? Getting all that cleaned out. We ended up taking occupancy down to, it was in the 40%. I got to update this slide. I don't know why we had it, but really we got it down in the 40s, right? It was like 45%. Next up, brought on security, clean up the property, really keep everyone accountable and start to show people like, hey, new ownership, this property's not going to be just kind of whatever people want it to be. It's going to be a community, right? And really managing that. From that, put a lot of money into it, clean up the property, started improving the interiors as well, right? We're able to increase rents. And then really in 4 months, we tripled collections, right? And that's an amazing thing. From kind of the bottom to where we got in 4 months, it was tripling that collection amount. And so, I mean, huge change in that property over the course of 4 months. And ultimately, instead of doing that refi we talked about, we ended up selling it, right? Again, there was just too much money on the table. Ben and I are opportunistic. We're happy to take an opportunity when it presents itself, right? And so we ended up exiting that property 18 months later, start to finish, 80% return to investors, right? So massive returns. And our investors obviously were very, very happy with that. And to give people some numbers, right? So that deal was actually not a big raise, $1.1 million. That was at the time, it felt big, but now you kind of realize it's really not that much. We bought it for $3.9 million. We had put about $900,000 into it. And so we sold the property for $7 million. That resulted in about $2 million of profit to investors. I mean, significant. And so, yeah, that's that deal. And I think we are right on time, almost exactly. So
we blew through that.
I think we got through everything we wanted to get through. So we'll do
a high note.
That's how you get
Yeah, profit $2 million. Hey, Q&A. All right, so open Q&A. This is where we know if there's no questions, it means you did such an amazing job. Like there's no ambiguity.
I know somebody's going to have a question.
Yeah, I got one. So you're here in Houston. This is your one of your first deals or your first deal?
One of the first deals in Atlanta.
Okay.
Yeah.
So how did you get from Houston with one of your first deals in multifamily all the way in Atlanta? And then a follow-up question, why?
So luckily the answer to that question is almost the same answer. So both questions are all the same answer. The reason for that is Texas in general at the time, right? We could buy a deal anywhere in the world, anywhere in the country, but ultimately needs to make sense financially, right? Texas at the time was getting heated. Atlanta was another market that was very attractive, right? We are looking for job growth, population growth, and kind of from the macro to the micro, really digging in to reduce risk. And so Texas was getting expensive. We were struggling to find deals that made sense in Houston. And at the time, Atlanta was a market that was, again, booming, a lot of growth, job growth, you name it, it had it. But more importantly, pricing made sense. We could buy assets at a good cost basis. Right now, we're starting to feel like we might get priced out of Atlanta. We have several assets in Atlanta, but things are trading so high, like we're just going to sell stuff, right? So, it needs to make sense from the market to actually the price that I can buy things at, right? Like I love Austin. Austin's a beautiful market, but I can't find things that are priced effectively, right? It's really, really expensive in Austin, right? Versus I can go to Detroit. I could probably find things that are priced really well, but the market isn't that attractive, right? It doesn't have the other macro indicators. And as an owner, you can improve the property, but you can't change the location, right? So,
all right. How was managing that project on one of your first projects, large project, and in another state, another town, far away? How was managing?
I think luckily we had a good property management company. We also had a very, very good on-site manager. Now, the first one that we had when we first took over, it was a lady. She didn't do as well. And so we asked the property management company to move somebody else in. And it was a more seasoned gentleman that had done these types of kind of repositioning, heavy rehab plays. He knew this demographic and how to talk to them. And he ultimately was very, very successful. So I would say that he was a big part of our success. But also, I mean, we had to get out there quite a bit, man. We were going out there 2-3 times, not a week, a month. But luckily from Houston to Atlanta, there's 12 flights a day through Southwest.
We day trip to Atlanta.
You literally could day trip. You could go out at 6 a.m. and you could take the 8 p.m. flight back, and you're back in your house that night, right?
Really hard to do that now.
No, it's definitely a little bit more challenging now that COVID's kind of hit. But people always say, oh, that's far away. Well, it's a 2-hour flight. You could spend pretty much the whole entire workday in Atlanta and then be able to fly back. So we were able to really knock it out. And we had a couple good general contractors that we relied on that were doing a lot of the heavy lifting out there. So ultimately, once again, I go back to it was the team. We had a good team in place, and we were able to kind of maximize the value on that because of that.
Awesome. Wow.
Yeah.
Okay. We have a question from.
I have a question.
Okay, Kelman.
Yeah, it kind of goes into what you were saying at the end. I just wanted to ask, how have you seen COVID affect multifamily market positively and negatively?
Yeah. So, I mean, you want to take this one
Go for it.
first? Or? All right. So, I would say negatively, ultimately, if you're in class C and B, there is going to be obviously some challenges from a job loss standpoint, right? But you're going to see that across the board. I wouldn't say that it's only isolated to lower income. I think, at least for 6 months, there was quite a bit of people that were just either staying at home or they were furloughed or they had lost their job temporarily. So that's really probably been the most negatively impacted. Positive impact, though, is that, the government is our biggest partner in these deals, right? The reason that we can get such good debt on these deals, I always tell people this, is because the government wants affordable housing for folks. What we're providing is quality, clean, safe housing for people that are in that $700 to $1,000 a month rent range, right? And so, they incentivize us with good debt and liquidity in the market to continue to improve our properties and continue to go out and buy those properties. And that has remained pretty much solid throughout COVID. I mean, yeah, April and May were a little wonky, but after that, things started really opening up, and Fannie and Freddie Mac, who are really the big players, which people probably have heard that name, right? They lend on multifamily all day long, and they lend also the rehab component, and that allows us to improve the properties too. So that's been a positive thing. I think the other thing that we've seen that's been positive too, is that there's been, I guess, a culling of the herd a little bit. Some of these people that thought multifamily was sexy, they got out of the market, right? And now we're able to kind of look at cleaner, newer assets that maybe before institutional equity might have probably, been the ones that are going to buy those deals. Now we're looking at 2013 builds here in Houston, so it's actually been a blessing in disguise too, from COVID standpoint. But yeah, I'd say that's kind of been the disadvantages and the advantages of it. Feras, did I forget anything or?
No, I mean, I'd say it's just been hot still through COVID, right? This is the first month we start to see collections drop, right? And so it'll be interesting to see kind of what the next couple of months look like, right? But very much, hopefully seeing if there's some deals that we could be had out there. So
yep.
Cash is king, guys. So
that's absolutely right.
Yeah, I've been listening to Robert Kiyosaki for years, and he kind of mentioned how Freddie and Fannie Mac was incentivizing to the point to where they were even paying some of the rents of some of the places during COVID. Is that something that you've experienced?
I mean, they're not going to, they certainly, I wish they would pay the rents, but they don't do that. But there's certainly, and they incentivize people, to make sure that the properties are taken care of. Obviously, there's been some eviction moratoriums, and they do that to the benefit of the resident, right? But on the flip side of that, if a landlord or an owner gets in trouble too, there's also forbearance too. So they've on the flip side of that, they've been, a little bit easier on, hey, if you can't pay your note this month, as long as you're not evicting people, obviously there's a process involved, and we haven't done any of this. I'm just telling you kind of people where things are at. So that's also a Fannie and Freddie mandate as well. So they're taking care of the landlords to an extent, and they're taking care of the residents to an extent as well. And, they do that because they need affordable housing. And there's a very big problem in this country with people not being able to afford rent. And so they don't want all these properties that are doing a good job to go under and then ultimately turn into slums, so it's in their best interest to take care of the whole thing.
Okay, let me get to Dom's question. He said, how do you evaluate the price of a multifamily? Is it price per door, comp, or cap rate, et cetera?
Ferris, you want to go with this one?
Yeah. So, the way multifamily is valued high level is based on really, they look at how much income is the property generating, right? And what that cap rate is. So cap rate is something everyone should get familiar with, simple equation, right? It's the percentage cap rate is the NOI over the value. Now that said, the way to think about cap rate is that if you bought the asset free and clear, right? No debt, no nothing, and you just ran it the exact same way the previous owner did, what percent return would you get? That's what cap rate means. Now, in multifamily, right? The way things get valued, the question is, how do I value commercial assets whenever there's not a lot of comps, right? Not like houses where you have neighborhoods of the same thing, right? Cap rate is what they use to value them. So that's how you can get a sense of how much is that Walgreens valued relative to that apartment across the street. Areas are cap rate kind of areas. So Houston right now is about a 6 cap on a, maybe a 5.5 to 6 cap on a C asset. A-class assets are probably going for lower caps. And so that's how they value things. Now that said, there's also, a property that makes $0 is not worth $0, right? There's some value in there. And so there's this kind of soft component, which is what value add can be done to the property. What is the potential of it? And that's where, it's kind of it gets a little bit fuzzy. But we look for assets that we can go in, have a clear path to implement a business plan, right, to improve the income and therefore improve our valuation.
All right, guys. Man, this has been fun. It's been awesome.
Great topic. Had many inquiries about multifamily, so it was great that the pros were able to cover that.
Always happy.
Do we have time for one more question?
Go for it.
Yeah. So, given the current rates that are going on right now with even single family and multifamily, I would be like, a beginner in it. So I just wanted to know from someone or two guys that have this experience, like if you could start all over again, what would you say to yourself or someone starting fresh in this current climate of multifamily marketing?
Yeah, obviously, man, get yourself educated. That's the first thing that I always tell people. It's a very complex and risky business. There's a lot of bad information out there. So I always tell people start there. But then ultimately, once you kind of get a good foundation, ready, fire, aim. Do not overthink it. There's a lot of analysis paralysis out there where people are overthinking every little risk or every little thing that could go wrong. And then they ultimately never make an offer. What we do is inherently risky, but there's never going to be any reward if you don't get up to bat, right? You can never hit that home run if you never get up to bat. So I always tell people just get in there and start making offers. But first get that baseline education first is what I always kind of suggest people starting off, right?
All right, guys. So y'all have a podcast, or at least a live streaming TV show, right?
Yeah, Money Mondays every Monday, 3:30 Central. So
Money Monday.
Check out the Distrupt Equity Facebook page.
Disrupt Equity Facebook page. Money Monday. You said 3:00?
3:30 Central.
3:30 Central Time. Live on your Facebook. I've seen y'all's studio. It's pretty sweet.
Thank you.
Y'all got great content. I appreciate it. How, if anyone else wants to reach out to you other than Facebook, is there any other ways, or is Facebook the best way?
LinkedIn or email addresses. So Feras@disruptequity.com or Ben@disruptequity.com.
Yeah, definitely check out our website. We've got a lot of tools out there, a lot of free content. We like talking about this stuff, folks. So just, let us know how we can add some value.
All right. Look forward to hanging out with y'all again soon. Thank you.
All right. Thanks, guys.
Thanks for having us, guys. Appreciate it.
Yeah.
Bye.
Thank you.
Bye-bye.
Yeah, and our next event with REHacking Live will be next Tuesday, or the first Tuesday of November. We don't have a speaker lined up just yet, so stay tuned. You'll be able to find more information at REHacking.com/REHacking Live or on our Facebook page at REHacking or Invested Agents. Otherwise, we'll see you then.
Bye, guys.